Hello everyone. So today we will be continuing with class 4 and I hope everyone's doing well. So we've so far covered, I have the specification in front for you guys. So far we have covered the learning outcomes 1, 2 and partly 3. So we will be looking at the session which we continued last week and then the continuation of it. And then we will also have a look at the learning outcome 4, which is the financial consequences. So we have covered thus far, about the different strategies and the implications of mergers, the acquisitions, the types of it, and so on and forth. So the same way, we will continue with the learning outcome 3, whatever that we've halted on the previous session, and then we will continue with it and then move on to the learning outcome 4 as well. So that will be the coverage today. So we will be basically covering these areas here. And as you can see, when looking, I think we have covered majority of the strategic aspects, but then that is one of the very important aspects. But then today we will be mainly focusing on the financial consequences. The financial consequence, when you see financial consequence, it is not actually a vast area. It's a bit of a constrained area, but then it's very important for you to understand the concept of it, right? Because final, like I told in the first class itself, how interconnected the departments are. In the same way, we need to understand the importance of finance, because obviously this is the level 7 diploma in accounting and finance. So you will have a variety of different modules that you cover in terms of finance, and you have different numbers involved and so on and forth. However, like you need to understand, because strategy is not something that is directly connected with finance, but however we are looking into that aspect much more in detail here, because as I previously explained, it's the connection. Okay, so you need to really understand how important it is to connect the financial consequences in terms of strategic decisions made. Because any organization can make a decision, right? They can make any sort of a decision, but it is very important as to what sort of a decision they make, and whether it is whether the decision is financially feasible. All those things will need to be addressed, because if in the event where it is not addressed, it will actually cause a problem. So you cannot implement the strategic decisions. So it's very important, any sort of a strategic decision you make, because without the financial feasibility, we can't do anything. And that is the reason we have certain methodologies to analyze it, because we do calculations, we analyze it, and then we, come up with concrete solutions as to, okay, we are going ahead with this decision or not, right? So it is very important. Therefore, we will address that section too, but however, it is not a very vast area, because this is theory. So obviously the calculations and details with regards to analysis calculations will be discussed to you guys in different modules. There'll be tutors discussing with you guys, but however, it is not just about the numbers only. If you come up with calculations, you should know how to write it down. You should know how to make a stakeholder understand as to what this calculation is, what the outcome is, and so on and forth. So as a result, the financial implications, the consequences as a result of the strategic decisions will need to be understood, and then it should be applied. Okay, so that is what we will be going through in today's class. So let me just settle in. All right. So this is what we're going to be addressing in today's session. So let's move on to this. Right. So today we will be actually looking at the strategic implications of mergers and post-mergers values. We looked at in detail about in the previous session, we looked at in detail about the what is a merger, what is acquisition, the different types, and then the pros and cons, and so on and forth. So in this session, we will be looking at the implications and we will be covering the rest of the units. The rest of the assessment criteria, like we discussed earlier. Okay, so I'm going to read this to you guys and then further explain like I usually do. So let's move on to that. So today we will be looking at the evaluation of post-merger or post-acquisition values and processes. So last class we also addressed about the importance of values to businesses. So you should understand by now, you should have understood how important the concept of value is to the businesses. So in understanding that, let's further go forward with it. So with regards to a merger or an acquisition, it is vital to determine the correct price to be paid for an acquisition or merger. Okay, so determining the correct price, meaning how will you determine? So last week we also discussed on the concept of goodwill, because if in case you are buying an organization, if you are going into a merger, or even you say you're going into joint ventures and anything as such, right? You need to analyze the price for it. So in order to analyze the price, it's very important that you know the goodwill of the organization. Goodwill means, of course, the quality, to what extent the organization has grown. So it is vital to determine the correct price to be paid for an acquisition or merger. It's not too less or too more. Okay. Two companies should agree on how to share the synergies. Additionally, post-merger values or post-acquisition values also play an important role in determining the success of a merger or acquisition. Okay, so it means the two organization has to share the synergies. They have to work in common. And then post-acquisition or post-merger values. Unless the post-merger work is successful, a major acquisition will not add value. Integration and synergy realization require involvement from almost every part of the organization. So this clearly says how important it is to work together. Okay, although there are different departments in an organization, it is very, very important for them to work together. So this concept will be addressed here. Okay, so you need to be very careful when you address, when you are even looking forward to expand and then you want to have a merger option coming forward. So you need to make sure how, what sort of a price it is paid, and what sort of a value it has, and whether all the departments in the company um, you know accepts it. Because I'm not talking about all the employees there, but then at least the board, all the people in the board should be made aware of it, and then such decisions should be made. Because it's going to be really hard if no board is properly wanting it to be done. Of course there will be stakeholder in conflicts and stuff, but then of course to some extent there should be an agreement being made. Okay, so it is very important in that sense. So let's move on. Right, so here they discuss about the motives for your merger. All right, 1 second, guys. Right. So we will look at the motives for a merger. So basically, think when you are, it's easy for you to understand if you think this way, because that would make you apply it to yourself. So now you have a business and you want to merge. Okay. So um, what do you think would be the reasons for your merger to take place? Right? Because you wouldn't want to merge with another organization, either it be horizontal or vertical. You wouldn't need that to take place without reason behind it, right? So you need to make sure that you understand the importance of it, and then so you listen to whatever I'm saying so that you'll be able to connect it and understand. So you have a business, you're going to merge. Why would you merge? Basically, motives are the answer which is given to a question why. Okay. So here they say creating value. So they have segregated the motive into three different categories, which is creating value, cross-border mergers, and dubious motives. Okay, so first would be synergy, working together. So that because you when you work together, there is more growth uh, that is tend to take place, right? And then growth, obviously, you want to grow your business. You don't want to stay in the same scale. You want to expand as an organization. You want to, if you are in the national market, you want to move into international markets, right? So that is one of the very important points there. And then increasing market power, because, for example, if you are going into an horizontal merger, you're going to have more enhanced market power, right? So in that case, it is of an obvious advantage. So there is increasing market power. So that's one of the main motives there. And acquiring unique capabilities or resources. Okay, so this could be a very beneficial example in terms of vertical integration. Okay, you are moving into acquiring unique capabilities and resources. So through that, what would happen? Whatever the capabilities and resources that you do not have currently in place, you are going to expand that through your merger taking place. Okay, so you are growing. Unlocking hidden value. Okay, so you when before the merger, so of course you are going into you are merging with different organizations, so they will have set of values, they will have a set of resources, and because of the merger taking place, you are unlocking the hidden values, whichever that your organization has been lacking before. You are going to touch those points with the new merger that you are intending to go forward with, and then you're going to expand in that sense. So let's look at the cross-border mergers, exploiting market imperfections. Right. So this is about not within the organization, but it's about the outskirts of the organization. So you're going to exploit market imperfections, and then overcoming adverse government policy. So because you as an organization operating in economy, sometimes there would be situations where you won't be able to compete. You won't be able to um, cope up with the different government policies and rules and regulations that are coming. But however, if you do go merge with an organization that is well established, okay, so what happens is you are able to benefit from the adverse government policy, because the organization or the brand whichever you are intending to merge with would have certain capacities that could overcome such adverse events. Okay, So that is one of the very important points, because nowadays the organizations face a lot of stress when it comes to operating in the markets, one being the government rules and regulations, and of course COVID, and a lot of external causes taking place there. So it's very important the organizations to understand that. Plus also, only if they understand, they can actually come up with strategies to overcome such adverse events, right? And then technology transfer. Of course, this is a major benefit in terms of, we could also call it as a benefit, we could also call it as a motive. There's a technology transfer taking place. It could be in both ways, suppose you are company A and you are merging with the company B. You have advanced technology, now you are merging with them to further expand, but of course not up to your capacity, but to some extent. On the other hand, you as an organization may be lacking in the technology, and whereas the company you are going to merge with could be highly tech. So in that sense, there is a lot of technology transfers taking place and expansion taking place in terms of, artificial intelligence and so on and forth. Okay. Product differentiation, right? So this is a very important element. I personally think that something of this nature is very important for you as a business person. Sometimes, even if you are not a business person, even if you are in organization working, if you are acting as an employee, it is always beneficial to have, two or three types of jobs, where you can, work parallelly. Because if in case you lose if in case you lose your employment in company A, you always have company B and company C as in your hands, so that you do not have to worry much, right? So that is a very flexible approach. That flexible approach is very, very good, I would say. So in the same way, that is actually a simple example that I was saying. The product differentiation is basically, you as a company, you do not just produce something that is according to whatever that's in line, right? Maybe you go and merge with an organization that is completely not your product line, but completely different one, which we also call as diversification. Okay. So you do not have to depend on one. In case the product line that you are producing now loses the demand in the market, you always have another product in line. Okay. So you can cope up with that. So that is one of the major motives of one kind of a merger, because we also studied the different merger types, right? So this is one sort of it. So this is one of the main motives certain companies would have, because they want to survive in the markets. Most of the time, this product life cycle, right? So most of the time, this takes place when the company is aware that it is going towards the declining stage. So when the company is aware and is known that it's going towards the declining stage, what they would do is they would go into mergers as such, so that they know that the product is declining and they need to move forward. They need to mainly sustain in the markets. So in that case, this is very important, and it's one of the motives too. And then to following clients, it can happen because you have a certain set of good number of clients out there, and you want to merge with an organization that has good resource capabilities. So you're going to go ahead with that. So following clients is also one of the motives. And then dubious motives, diversification, like I explained before, bootstrapping earnings, managers personal incentives, what I told about flexibilities, and then tax considerations, of course. So tax considerations also is one of the most important things, because you can merge with an organization which is very well defined and very well taking forward their taxes in place. So in that case, this is also one of the motives of the merger to take place. Okay. Right. So here we have the reasons for failures of mergers and acquisitions. So let's look at some of that option here. Post-integration issues. Certain issues of a target would be known by an acquirer only after an acquisition. Some of these later findings can be of significant scale, say hidden liabilities of the target entity, which would need significant amount of money and effort to rectify. Furthermore, acquisition may not be justified. That is a very big disadvantage, right? Because what they are saying is at the time of your merger, you are not very well aware of what is exactly happening, right? And you don't know if the organization would have any debts, because sometimes they would not they would not actually point it out because they wanted to somehow sell the business. So in that case, that is one some of the failures, because these are such hidden liabilities which are causing so much of implications. So that is one of the reasons why mergers and acquisitions fail. Mismatch between corporate cultures. That is, now you are a company A and you are purchasing, that you are merging with or acquiring company B. The culture of company A is completely different from the culture of company B, which will have a major effect. So in that case, although you have bought it, you will not be able to run the operations. Of course, you're going to buy it with the employees and all, right? So in that case, it's going to be of a complication, right? Okay, guys, just give me a minute, please. Okay. So like I was explaining previously, um, so that is a major problem when it comes to cultures. If the cultures don't act in a very um, accepting manner, that's gonna have a difficulty in adapting to that the merger or the acquisition that took place. So that will cause a failure. Okay. Also, lack of managerial expertise. This is actually this aspect is not just for the mergers or acquisitions, but it is also for any, even if it is like a normal organization. I would say if there is no proper managerial expertise, then that would be a problem, operating. It's not just about, mergers or acquisitions, but it can be for any organization. The managerial expertise is a problem, right? And then you have also indicated paying too much. This could be a common occurrence as the senior management team that drove the acquisition may have been motivated by their personal goals. This incentive to build empires may have caused high monetary cost to the acquirer. Okay, so this is some sort of a type of a fraud, I would say, because this is something happening because of some personal goals. So there would be more monetary cost involved. So that would also result in failures, because sometimes, you buy this, you acquire the organization. Of course, you would need to do something related to, um, related to like cover the costing. That's why we have calculations such as net present value and so on forth, right? So those things we need to be very careful. So sometimes it's not really visible, but however, like, it happens in majority of the businesses. So this will also result in failures in terms of where the cost cannot be covered. So in such instance, that will cause a failure. Too much cost, and the cost cannot be covered, and that's going to create a problem. Okay, so that these are few reasons why the mergers and acquisitions would fail. Right. So this is about, let's look at this section here. There is a greater interconnectedness among markets around the world as a result of globalization and business opportunities in far corners of the globe and increased communication. Okay, there are new investment opportunities for investors, and they can study new markets at a great distance than before due to globalization. All right, because this is what we actually covered, in the initial classes about the globalization. So it's very convenient. It's becoming more convenient, and the connectivity is much more prominent, right? Also, through increased investment and trade, countries with good relationships are able to increase their unity with each other, since the products and services are widely available in the new markets, resulting in directly improved economic opportunities for workers. These opportunities result in wider range of investment options for investors, right? So this is something to do with this is actually something to do with the globalization. And because sometimes it's not just about the national companies, right? A company in the national economy would want to acquire or merge with an organization which is operating international. Even because of globalization and the business opportunities that are rising from the different parts of the world, the the connectivity is very much possible. So it has actually boosted. So this is a real benefit to businesses, and the strategic enhancement is much more prominent. So that is what this section tries to explain you. Because of the business opportunities, because of the globalization, the expansion is greater. All right. Okay, so we will go through these sections about what strategies and everything, because this is more of um this is more of strategical module type, but I'm going to take you guys through just to give you a brief idea, because you know where you are to go to, right? So let's look at that. What is a strategy? A strategy refers to the actions that managers take to attain the goals of a firm, because strategies are action plans, right? You have certain goals in your business. You might need to enhance your profit. You might need to expand into international market. You might want to have 2, 3 branches in certain populated areas, and so on and forth. So these are your goals and these are your motives. So what strategy does is, understanding your goals and motives, you develop strategies, action plans. So these action plans are then analyzed, evaluated, and then put into implementation, right? So these are some of the goals, increase in profitability, and then you have to increase your net profit, expanding internationally, reducing cost, economies of scale, enhancing your values, and so on and forth. So for all these things, you will have strategies that needs to be developed. Sometimes the strategies could be short term, Sometimes the strategies could be long-term. It depends on what sort of a goal or a motive that a business might have. All right. Okay, so this is about value creation, which we discussed before. Okay, so this is about how firms increase profits through international expansion. So we've actually covered this before, but of course, we'll just have a look at it now. International firms can expand their market, which is to increase profits through international expansion, sell in international markets, realize location economies, you disperse value creations, you move into different locations, realize greater cost economies for experience effects, serve an expanded global market from a central location. So that means if you are going to base in a central location and you're going to expand the global market, which means there is more foreign currency inflow for the organization I'm talking about. I'm not talking about the economy here, because that is something we completely, we are different. We differently discussed about that. So that's about this. And then you earn a greater return. So when you expand, you of course devise strategies and expand yourself in order to earn greater returns. So these are some of the ways in which the profits could be improved through international expansion. Okay. So this is a theoretical element here. So as you can see, there is pressure for cost reductions and pressures for local responsiveness. There is high, low, and then they have different categories here: global standardization strategy, transnational strategy, international strategy, and localization strategy. So there are 4 basic strategies to compete in the international markets. The appropriateness of each strategy depends on the pressures of cost reduction and local responsiveness in the industry. So the 2 elements here, the cost reductions and then the local responsiveness. So when you are moving into an international market, you need to make sure that where the country you are moving into is actually the consumers there, or the people there are welcoming. Are they welcoming your product? And the cost reduction, is the cost of the product reduced? I mean the manufacturing cost there, right? So these are 2 important things, because based on this only you can derive at your prices as well. And then based on the local responsiveness only, you can actually derive at a decision as to you are to move or not, you are to expand your operations or not, right? So these are some of the very, these are strategies actually: global expansion, global standardization strategy, transnational, international, localization. So these are strategies that businesses would decide to go ahead with depending on these 2 categories of analysis. Okay. So here is it. Here we've got clarity on it. So let's have a check on it. Global standardization, increased profitability and net growth by repeating the cost reductions from economies of scale, the running effects, and also the location economies. Localization, increase profitability by customizing goods or services so that they match tastes and preferences in different national markets. Okay. Transnational tries to simultaneously achieve low cost through location economies, economies of scale, and learning effects. International take products first produced for the domestic market and sell them internationally with only minimal local customization. So these are the different categories involved. This is about the strategic decisions. So the strategic decisions could be of long-term complex decisions developed by the senior management, which affects the entire direction of firm. It consists of less complex, medium-term, and tactical decisions. So these are the 3 categories: operational, tactical, and strategic level. So it can take different forms, which is operational is day-to-day operations, simple and routine. Like I told you previously about, the strategies could differ in terms of short-term and long-term, right? Tactical, so that's how to achieve a policy. It's medium term. More complex would be the long term. So it's about the senior management is the person who actually looks into all those elements. Okay. So this is also about the strategic decisions. I'm not going to take time discussing on the strategic decisions because that is a very direct element here. You can actually go through the slides with me. Okay, so let's have a look at the financial consequences too. Like I explained in the previous, in the current session, in the initial stages, financial consequences is very important, but that does not actually take a major section here because it's actually interconnected. It's you can't study it separately and come up with an outcome because it has a connectivity towards it. Okay, so you need to understand the importance. I think we've covered the financial elements important and also the connectivity with the different departments, the importance, because that's how the business is built and the business has to run. It means if the business has to run, meaning it needs to have a strong financial capability. Okay, so let's look at this section. The tendency of facing financial consequences is high if the strategic decisions taken does not align with the organizational structure, as this may result in income inequalities of the organization, which would stagnate the growth. So you see, it would stagnate the growth. So therefore, it's very important to have the financial consequences understood because the financial consequence is high if the strategic decisions taken does not align with the organizational structure. And then if that doesn't align, that it's gonna actually cause a lot of problems, a lot of cost. Okay. If the top level of managers take decisions that are not suitable, the volume and volatility of capital flows increases the risks of banking and currency crisis by creating weak financial institutions. This is of a major problem. So, therefore, it's very important that the top level managers make effective decisions, understanding where they stand, what is the situation outside, whether the company is able to accept it or not accept it, and come up with decisions based on that. If they do not consider both internal factors and external factors affecting the organization, the decisions they make will not be effective, and that will cause a major problem, right? So, this is a severe issue, and every organization will need to understand that, especially the top level managers, because they will be the main decision makers for a longer term contact, okay, not for shorter term. International business entities may stagnate as financially poor organizations would not be able to cope up with the vigorous competition among developing countries. Okay, so this is about the level of competition because what they're saying is the entities may stagnate as financially poor organization would not be able to cope up with the competition among developing countries. So in that case, it will also create a financial consequence. Right. So having said that, let's look at this section too. Strategies implemented incorrectly and the effects to the organization is irreversible, as the sunk cost cannot be recovered in a short period of time. Okay, so what sunk cost is that? Sunk costs are the costs that cannot be recovered, right? So when you have incurred such cost, that's one time. You cannot work towards recovering those. So when certain strategies are implemented in an incorrect manner, which is as a cause of where the management is not considering the current and the past issues, or maybe the internal and external factors, or maybe the lower level staffs, the middle and day-to-day operational employees considerations, because they would also know what's happening. But if in such cases what happens is it becomes a problem, right? So, or maybe you can recover it in the longer term, maybe by making more profits or as such. But sunk cost is something that every organization, every business would actually face, right? So it's a very important element, and this is as a result of this, the strategic decisions the company makes should be made properly, because a business can make an irrelevant strategic decision once, twice, maybe thrice, but then if consecutively their decisions being made is not to the right level, in that case it's going to cause a lot of problem, right? So therefore it's very important the strategic decisions are made wisely in order to avoid financial consequences. Strategic decisions have a major impact on the long-term sustainability of the organization. This emphasized the fact decisions always should be made with financial capabilities viable to the organization. If the organization fails and leads towards bankruptcy, this may lead to long-term debt and will be a result of low foreign direct investments. Right. So it's very important. It's very clear here. Your strategic decision as a business person needs to be made properly with suitable considerations, because if not, it's going to affect the long term sustainability of the business, because they're not going to be able to survive in the markets without having a financial stability. That's going to create so much of issues, that's going to create so much of mess, right? Therefore it's very important that the businesses need to understand where they stand and what sort of decisions are being made in order to develop even have growth towards their operational elements. Okay, so that is about this section. So we have covered basically the learning outcomes 1, 2, 3, 4, about globalization, the value enhancement, strategic decision, financial consequences. So having covered all these areas, now you should be able to develop your assignments covering these requirements. Like I explained in the previous sessions too, there is always a connectivity when it comes to writing your assessments. So it's not just about writing in point forms. You need to be aware of uh, how the flow should be. For example, there is question asked and you have to provide an introduction section, you have to provide in the body of the answer you need to provide the requirements they give in terms of different main headings and subheadings, and then support with a conclusion, then reference. So you need to be able to connect it and develop your assignments. So I'm gonna take this off and then let's see. Right, so we have covered all of this section as of now up until the unit 4. We have this information on sources of finance to be covered, how to manage the global risk, and also the potential decisions, investment decisions, and global strategies, which are going to be very interesting. So I will stop with this now, and we will see you in the next class. And we will cover the rest of the learning outcomes. Okay. And in case of any questions you might have, you can always email, and we will get back to you as to how or we can further cover certain areas, or any questions you might have with regards to your assessments. We can always get back and we can have a session on that as well. Okay. So yeah, thank you guys, and I will see you in the next class.